Good morning. This is Michael DeVille. We're here in the fabulous studios of West USA here in beautiful Phoenix, Arizona. Tatum is in here with me. And of course, if you look on your webinar, there is a spot on the right-hand corner. If you have a question, we'll try and answer this. This webinar will probably run about 20 minutes today. We're going to talk about the accumulation phase that we're entering into. But if you have a question, Tatum will try and we'll get that answered for you. Also, if you have questions and you'd like to have the PDF or the slide file, we're more than happy to provide that for you. Tatum will get that up onto the up to YouTube as well. So you're welcome to share this video and take a look at it at your leisure. So what we're going to talk about today is the accumulation phase. We are moving along. As you know, I have a timing model. The timing model has been deadly accurate. I'm going to talk about it just a little bit today so you can see where it's at. And you can see what phase that we're going into in your financial world. And it's really now time to start buying properties, start to get a little more aggressive. You know, as if you've been following my work for the last couple of years, I have been fairly conservative. We've been using mostly cash or lots of down payment, and now that is starting to change. I raised Phoenix to neutral last year in the third quarter. I'm starting to get to the point we might be raising Phoenix to a minor buy just because the demographics here and all of our trends are just incredible. So we're going to be raising that up, not quite up to an aggressive buy, but we're going to start looking at that. And let me just go to the next slide and let's talk about this. So I think you can see this just a little bit better. We have been here for a little while, and my concern, of course, was I could see in on the charts that this was March of 2018. I knew that we were going to go down. On a national basis, we did go down, and you certainly saw that the rate of change and rate of growth certainly slowed across the country. There was no qualms about that. And then in the fourth quarter of 2019, we said that it would stop, but it would be a spike. And of course, we've gone up the spike. We've seen it here locally, just incredible. However, it has been a national phenomenon. We are going to come up here. This is pretty much where we're at, right around the spike here. It's starting to slide down. And then we're going to come down just a little bit. Now, this is still going to be these are corrections in an ongoing bull market. We are certainly going to go up to the top here. We are way too early to be finishing the cycle. So we are coming into the accumulation. From here to here is where we're going to want to start accumulating properties so we can get up to here. Now, let me just go to the next slide. Now, I just got this slide literally just yesterday or the day before. It's been used by a couple other analysts. This came off of Bloomberg. But if you look at this slide, you can certainly see right up here that we have a spike that goes into this right here. You can see the spike. Now, this is from my timing model. And of course, this is that spike that you can see on the actual models. You can actually see what's happening, and we're going to start coming down just a little bit. Now, keep in mind, it's strictly a correction in an ongoing bull market, and it's going to give you a really strong opportunity to buy these properties. Maybe we get a little better pricing on this. Here in Phoenix, I'm not so sure that that's going to happen. Nationally, of course, I think you're going to see that. So the great markets in Florida, Texas, and Arizona are not going to experience much of a slowdown, but around the rest of the country, they may very well. But it is a correction in an ongoing bull market. Now, I'm going to tell you that very few people are going to recognize what's coming. This is very typical. We're going to be entering into a recession. People are going to get very scared. This is going to be probably like a distorted W. It might be a series of W's, very, very similar to what we experienced in the 2001 to 2002 recession, commonly called the dot-com bubble, where we saw the economy come up just like it did in the last 2 quarters, and then they have it viciously come down later for the next 12 months. However, if you recall, now that's one of the things about being my age, is that we do remember the fact that the real estate as a separate asset class was almost totally unaffected by that. And of course, 2002, 2003 were precursors to 2005, which is very, very similar to my timing model. It seems to be unfolding pretty awesomely. I mean, it's uncanny how well this timing model has been working. And I'm going to tell you, here's what's happening. We're seeing that people are kind of concerned. They're pulling in their spending habits. They're not they're putting money into their savings accounts. Typically, we see pretty close to between 7 and 8% is the normal savings rate. And of course, when we got into the recession, you can see that people quit spending and started saving, and we jumped up to 32%. Now, I'm going to tell you, when you get 32% savings rate, that it's very difficult for the economy because we're a consuming economy. And as we start seeing 32% of the money going into your savings account, means they're not buying cars, they're not buying furniture, they're not going and buying all the things that we like. They're not buying things for the pool. We're saving. Now you can see that people are starting to feel better because the last in May it came down to 23%. I'm assuming that it's probably going to come down to probably 18 or 15%. But until that comes back down to normalize, which is going to be between 7 and 8%, a lot of people are going to be sidelined. Now, those that understand what's going on with the cycles are going to have a distinct advantage because this is when we should be buying. We're entering into the accumulation phase. We should be buying now. So I'm telling you, we're going to start getting a little bit more aggressive. I have been very, very risk averse. I'm going to raise that up to a little bit where we want to start increasing our risk. We want to start accumulating properties. We're going to start wanting to go ahead and leverage more. This is for when you start getting leverage at 3%. A curious fact is that as prices have gone up fairly significantly, actually the average home payment, mortgage payment, has actually come down about $40 because interest rates have come down. So even though prices have gone up, the cost to own the house has actually come down. So there's a little bit of fear in the market. Those that are interested in buying should be starting to look right now. We're going to have 5 or 6 months where things might slow down a little bit. It is an incredible buying opportunity for you. Now, we're going to start seeing people going to safe harbors. So here's another couple trends that I'm going to tell you we're going to start seeing here in the great markets of the United States. We're going to certainly see this in Phoenix, Arizona, is that real estate is going to be considered a safe harbor. Keep in mind that there's a lot of risk in stocks. There's a lot of risk in bonds. People have money. They don't know where to put that money. They're going to be looking for a safe harbor. And real estate, and particularly cash flowing, conservative, single family residential homes are going to be incredibly conservative, and people are going to want to put their money there. So this is an absolute wonderful time for you to start buying. You should start accumulating properties. Now, we're seeing problems in the marketplace. You're seeing volatility in the stock market. You're seeing the stock market rising on the back of only 4 stocks. So when you start seeing this concentration of wealth into only 4 companies, that's telling you that the rest of the economy is something wrong. It's distorted. Those are big red flags for you. Now, you should be talking to your financial advisors and saying, what is prudent for me to be in the other marketplaces? So those marketplaces would be the stocks and bonds. Those are something that you really need to talk to your financial advisor, find out what your exposure is, because humbly, I think those markets have been distorted, and we have metrics going on that really can't be counted on, and they need to be going into a separate asset class. So if you do not have money in your retirement accounts, if you start feeling that you are getting to the point where you're not making enough money and your retirement accounts have been just on the short side, now is the time for you to start making some money. You can start including real estate into your retirement accounts. Now, we have here in Phoenix, now this is not unusual across the country. Now, across the country, real estate has done exceptionally well. So around the country, I'm hearing that places are hearing up to 6, 7, 8% appreciation year to date. So in the last 6 months, properties have gone up 6 to 8% across the country. Here in Phoenix, we're looking between 9 and 12.5%. So we're up 50% above and beyond what other places in the country are doing. So we should be talking to you about stacking into your retirement account. Our timing model is telling us we have 3.5 years before the peak. That 3.5 years are going to be very, very significant. So if you have gaps in your retirements, if you're not getting enough, if you want to start putting some assets into your retirement accounts or outside your retirement accounts that you're going to be using for retirement income, now might be the time for you to start considering doing that. You need to talk to your financial advisors. You're certainly welcome to call me or call any of the people that are trained here. We're more than happy to discuss this with you. With interest rates as incredibly low as they are today, it's time to start filling this up. Now, you know I'm a little concerned about investing into bonds when rates are this low. So we don't want to be a lender at this kind of rates. But we do want to become a borrower when we're talking rates that are this historically low. This is going to be an incredible advantage further down line. So we need to start thinking of any time that you've got a gap in your retirement, this might be a time for you to fill that gap and to get some more assets and to start healing it. So your retirement income is coming to you. Keep in mind you are going to need income in your retirement. So we're going to want to start transferring wealth into income and wealth. So I think in the next 3.5 years, we're going to have one of those unique periods in time where you're going to get really, really good capital gains, but also really, really good income. It's just absolutely terrific for baby boomers, those that are 5 or 10 years away from retirement and want to start putting some money into their retirement fund. This just makes a great asset class for you to do. It's going to give you not only some peace of mind as the price of the properties go up, but we're looking at one of these periods where we're thinking that income is exploding to the upside and it's going to go way above inflation. So you're actually going to grow your income. This is just great. Keep in mind when you retire, it is not an age. It is a financial decision. So you're able to do this and to do this early. Just think in 7 to 9 years on a very strong strategy like this, your whole life can change. You can become financially free and your life will become your own. So this is what we're looking at. It's coming up very, very quickly. So let me just recap this. I'm going to be very, very conscious of your time. I think that we're looking at an accumulation phase. We've got confirmation from the marketplace. Bloomberg has published one of their graphs that are showing what's going on. You can fit it right into my timing model. It's validating where we are. It's showing us where we are in a timing model. It's telling us we have about 3.5, maybe 4 years to maybe a peak that's going to be very, very similar to 2005, where prices got really, really strong. If you think that if you think that what you've seen now, where you're seeing multiple offers, where you're seeing people overbidding, where you're seeing properties coming on the market within 5 or 6 hours, they've got 7 or 8 offers on them. You have not seen anything yet. When we get into the explosive phase, you're going to see that on every property. You're going to see properties go up incredibly. And this is just a recap for you. So let's start trying to figure out what's good. I would say you need to talk to your financial advisor, talk to your broker, find out how we can buy 1 or 2 properties in the next year to 18 months. Keep in mind, a lot of people are going to tell you that this is the wrong strategy because they just don't see the opportunity. We're going to have lots of problems in the marketplace. If indeed we go down a little bit on our timing model, which is it's indicating that's telling you that the general economy is probably softening. So we're going to look at instead of a V recovery, we're going to look at a W recovery. Now, we're certainly recovering. Things are going to get better. It's not going to feel wonderful for probably another 12 to 18 months. That's when all that liquidity is going to work its way through. But it is going to get better, and it's breeding opportunity for you. So I am welcome to answer any questions that you have. If you want to do it off the air, you certainly can. We're here to help you. So let me just tell you that we're here at the West USA. West USA would like you to get a absolutely terrific business going for yourself. But once you start making that income, they want you to take that income and invest it for yourself so that you become financially free, that you've got reserves, that you're building long-term wealth, that you can change your life, make your life better for you and your family. If you have any kind of questions, you're welcome to give you a complimentary consultation. We do this on a day-by-day basis. Just call, or you can email me at michael@michaeldeville.com. If you want to talk about diversifying your cash and transferring wealth into cash flow, you're more than happy to talk to you about that. Same as 1031 exchange services. We're getting lots and lots of requests from out of state. People are trying to bring their money here. So they're looking for replacement properties on a 1031 exchange. You're welcome to email to Creating Wealth at West USA, and we're more than happy to help you work with that. If you're just starting out, if you're just thinking that I would like to change my life, I want to do this, and I want to make a difference in my family, we're more than happy to help you. We're going to have a workshop going. We have people here that are more than happy to work with you and guide you. You're always welcome to call me at my office in Scottsdale at number 602-942-4200. And if you're a real estate agent wanting to upgrade your business, if you want to start thinking that I would like to get into the work with investors, and keep in mind, investors are about 29% of the total market here in Metro Phoenix. In the great markets across the United States, is going to be the same. There's a very, very strong. You're starting to see a lot of foreign capital coming here. People trying to get out of, we're seeing an awful lot of Europeans that are taking their money and bringing it here, earning US dollars. And if you'd like to learn to work with them, Todd Menard is putting together a certification course so that you can become a real estate investment advisor and become a certified real estate investment advisor. And you're welcome to contact Todd at toddmenard@westusa.com. So I want to thank West USA for giving me this platform. They really care about their agents. I'm here to help you any way I can, and I'm here to tell you, have a great week. Business is just booming. Thank you so very much. Bye-bye now.